Hey everybody, Jeffrey Dunyon here with Safe Option Strategies. Welcome to another episode of the Moving Markets Podcast. Today is Tuesday, the 23rd of January, 2024. The U.S. stock market has been closed for just right around maybe 25-30 minutes at the time that I'm recording this. Cannot wait to talk to you about Netflix and what's going on with Netflix. I'm going to talk a little bit about what the market did today as a whole. Talk a little bit about Netflix and whether you own shares of Netflix or not, whether you trade Netflix with option trades or not. I'm going to tell you why it's important to you and your portfolio as to what that news means and how it can affect other parts of your portfolio. So glad to have you joining us. Enjoy today's episode. All right, so as you can see, the indexes were mixed today. The Dow Jones Industrial Average was down 96 points, about 0.25%. S&P was up about that much, a little more than 0.25% to the upside. NASDAQ up almost 0.5%. NASDAQ had a pretty decent day. So before I jump into a couple of the stocks that we follow a little bit more, let me talk to you about a couple of stocks that we don't follow that were the primary reason the Dow Jones Industrial Average was trading to the downside today. The two big culprits, the two big things I think that were pulling the Dow down, well, actually three. There's three companies that were pulling the Dow down. Number one was MMM. A lot of people just call it 3M, ticker symbol MMM. For those of you that don't know, I have never traded these guys in my portfolio. I've never owned shares of this company. I've never done an options trade on them. So if they weren't in the Dow Jones Industrial Average, I probably would pay little or no attention to them, but I am very well aware of who they are. 3M is a production and distribution company in a wide variety and wide range of areas. They do a lot of different stuff. A lot of people know 3M for the sticky notes and the little stick-it notepads. That's one of the things that they do. I think it's kind of interesting that they call themselves, I'm looking at their profile over here, they call themselves a diversified technology company. But really, most people know them as a manufacturer of products more than services. They do a few electronic things. They do a few safety things, some healthcare things. But that's what 3M does. And they're a very diverse company. 3M had a rough day today. And the reason they had a rough day is not because they reported their earnings before the open of the market. It's not because they reported horrible numbers. It's because they did not guide well. They did not give a rosy outlook. In fact, they lowered their full year guidance for 2024. A couple of weeks ago, if you were watching any of our podcasts or listening to our presentations, I told you that this coming earnings report, one of my biggest concerns was that companies are going to beat the expectations for revenue and for profit. Those are that top and bottom line. Those are the two things that people look at the most with most companies. There's some exceptions, and we're going to talk about that with Netflix in a minute. But those are the two things that people talk about the most are top and bottom line. Did they match revenue expectations or beat it or come in short of it? Did they match earnings per share or actual profit? Or did they come in higher or lower than that? 3M did not have a miss on revenue or earnings, but I've oftentimes said over the years, I've got on a soapbox from time to time and talked about what a total BS game the whole earnings report is, because analysts will create expectations based on information they get from the company. And it's something that I believe is incredibly easy to manipulate. And the reality is it's not that hard for a company to beat analyst expectations for those numbers, because all they've got to do is share with the analyst numbers that will make them look better, and analysts lower their expectations and they lower the bar. And then it's easy for a company to come in a little bit better than that. I would like to believe that there are some very honest and very transparent CEOs and CFOs of big major corporations, but I also believe they're going to tell people what they want to hear or what they want them to hear and report on to give themselves a chance of looking a little bit better. But one of the things that's hard to get away from is a guidance statement. And when you set the expectation yourself, not the analyst, but you yourself as the CEO or the CFO of a company, you set the expectation for what investors can expect in the next quarter, the next year, the next several years in some cases. you better be pretty close to the mark, because if you're always painting this real rosy, real flowery picture and you're always coming up short on that, you're going to be in a little bit of trouble with your shareholders. Now, what is more common, and this may be what 3M is doing, I'm not accusing them of this, but what I believe is more common is that companies will downplay their guidance. They'll say, we're going to lower our guidance for this coming quarter. We're going to lower our guidance for this coming year. And they do that so that all the analysts will push their expectation down, or in other words, lower the bar, and then they have an easier time beating it. They might take a hit in their stock price one quarter so that they benefit the next 3 quarters in a row, and overall end up with a good year. That became a regular thing. I don't know if he's the one who introduced this, but in terms of my personal knowledge and when I saw this at play, Steve Jobs, when he was the head of Apple, was a master at this. If you remember back in 2002, 2003, through maybe the time that Steve Jobs passed away, every time Apple would report their earnings, they would have this almost doom and gloom type of guidance statement. They would always talk about, well, we're not going to do this good next quarter. These numbers might be under a little pressure this next quarter, this next year. And then they would always report and blow those numbers out of the water by such ridiculous percentages and such ridiculous amounts that they played that game. They might have one quarter where the stock sold off a little bit because of a weak guidance report, and then the next 3 quarters in a row, they would just absolutely knock it out of the park and just kill it, because they would beat those numbers by such a huge margin. Again, I don't know if this is what 3M is doing or not, but I believe it's a possibility, because I think there's a lot of CFOs and CEOs of companies that play that game. But the reason they took an 11% hit, that is a big one-day hit on a stock. The reason they took an 11% hit today is specifically because their numbers came in where analysts expected them to, for revenue and for earnings per share, but they guided down and lowered their guidance for the rest of the year, and people didn't like that. Johnson & Johnson was a little bit different. Johnson & Johnson came in also, and they were not nearly the same percentage, but Johnson & Johnson is weighted a little bit heavier in the Dow, and they had a rough day. And Johnson & Johnson's picture was a little bit different. They gave good numbers on their guidance. They gave decent numbers on their guidance. They performed well last quarter in terms of their revenue, their top line, and their earnings per share, their bottom line. What Johnson & Johnson did was they also announced today the settlement for this talcum powder probe. And investors don't love to hear that your company is going to pay out $700 million that is not going into research and development. It is not going to go into infrastructure building. It is not going to go into advertising dollars. It's just going to make a problem go away. Now, long term, that's not a bad thing. You'd rather see a lawsuit settled and not go to a jury. I've got a handful of friends that are attorneys, and every one of them, even though the case happened back in the 1970s, every single one of them says one of the first things they learned in law school was the famous McDonald's case, where a customer spilled a cup of hot coffee in their lap through their own negligence. They sued McDonald's because the McDonald's didn't warn them that the coffee was hot enough to burn them. I mean, you want to talk about stupid. I absolutely abhor the jurors that awarded this person a lot of money because they were simply their own incompetence, spilled coffee on themselves, and then got paid a multi-million-dollar settlement because McDonald's did not settle with them outside of court. They let it go all the way through the court system. They let it go all the way to a jury trial. And a really good lawyer for this person got a jury to award her millions of dollars. And every one of my friends that is an attorney said one of the first things they learned in law school is you don't let a civil suit like that go in front of a judge or a jury for a decision. You settle out of court. Most lawsuits are brought against companies in the hopes that they will settle out of court. So if you want to look at it through that lens, through the glass is half full, you would say it's better that Johnson & Johnson paid this $700 million than let this thing go all the way to a judge or a jury to make a decision. But most people have a tendency to look at the glass half empty, and investors say, we don't want $700 million to go out of this because that's going to directly impact us as shareholders. And that money is just, like I said, being thrown at a problem to make it go away. We'd rather have that money going into more R&D, more advertising, more infrastructure build out. So that's where Johnson & Johnson got hit. The third company that really made things difficult today on the Dow, and it's a much heavier weighted company, was Home Depot. Home Depot had a pretty good size sell-off. Now it's only 1.6%, but because they're a heavier weighted company, meaning they make up a bigger percentage of the overall value of the Dow, $5.91 per share sell-off is as big a deal for a 350. In fact, that's a bigger deal for a $350 company than an $11 sell-off is for a $90 a share company. So that's why Home Depot had a big impact on the Dow today. I got to be honest with you. I have traded Home Depot off and on over the years, but I don't know what happened that caused Home Depot to go down. I don't know what it is that apparently Lowe's was downgraded to a hold rating. And I imagine somewhere in this article, Home Depot is listed, or investors became fearful that Home Depot could suffer the same fate as Lowe's if the problems that caused a downgrade for Lowe's are things that are unique to that sector or that industry and not just unique to Lowe's. Oh, I'm sorry, there it is. It was the article right below that. Home Depot was downgraded to perform instead of outperform by Oppenheimer. So I never worry too much. Let me talk about upgrades and downgrades. I don't worry too much about a single company upgrading or downgrading another company. One broker, one bank, one analyst giving a downgrade to a company is going to have a 1 or 2 day effect on the stock. And then the stock is going to go back to doing what it was going to do based on things that are more important than what 1 or 2 analysts think. When you start getting multiple different analysts that are downgrading, or you start seeing underlying fundamental problems with a company that causes a ripple effect of more analysts downgrading, that's when you've got to pay more attention to it. But that was definitely part of the drag on the Dow. All right, enough of that talk. The other two indexes, the other two primary indexes were up and had good days today. And I'm not going to go into a lot of details about that, other than I will tell you that AMD came back a little bit today after a couple of days of not looking so good. Let's see, what are some other ones? Intel had a good day today. Gilead had a good day today. If you follow that company, there were a few others. Baidu and NetEase, two Chinese companies, both up over 7.5% today. That definitely helped the NASDAQ. But you had Microsoft, you had AMD, you had Amazon, Meta. I believe, I might be wrong on the Microsoft one, but I believe all of those others were up today. Apple had a decent day, up a little bit. And so the NASDAQ had a pretty decent day today. But the talk of the town for tomorrow, post-market and going into tomorrow, is Netflix. And you can see it is what's leading the headlines right here. Even if you don't own Netflix, let me tell you why this could potentially be important to your portfolio. Netflix, the pressure was on Netflix in this earnings report. A lot of people were saying going into the earnings report that Netflix was going to see a big jump up in their profit because of the crackdown on password sharing, and that the result of that was going to be a higher per user revenue. But the concern with Netflix was, would they or would they not add more users or more subscribers, or do it in the numbers that the market analysts thought they should do? So let's jump down here and let's go into it and take a look at some of the numbers. I believe it'll be here on the CNBC report. So I'm not going to try and read this while I'm recording this. I know somewhere in here you're going to have some information on what the analysts thought Netflix would add as far as new quarterly users versus what they actually added. We might have to dissect this a little bit more tonight and report on it a little bit more in tomorrow's page. But the headline that's up here at the top of CNBC is that Netflix added more users than what was expected. I think there was a banner headline up here. They added 13.1 million subscribers. I think I heard that the expectation, I don't want to be too definitive on this because I may be off, but I think I heard that the analyst expectation was that they were going to add somewhere in the neighborhood of 8 million. There you go. They added 8.7 million last quarter, and that jumped to 13.1 million this most recent quarter. That's the big jump. That's a massive move up. When you're not only increasing your earnings per or your revenue per member, but you're increasing your members by, what is that? Is that a 50% increase in terms of how many they added? That's impressive. That's really, really impressive in terms of how many new members that you're adding. And I'm sure a lot of that did have to do with the crackdown on passwords. A lot of people that were using someone else's password had to get their own. Now, one thing to watch out for next quarter, if you are trading Netflix on a regular basis or own them in your portfolio, is you can't expect those numbers to be as good next quarter, because a lot of that growth probably was people that use Netflix on a regular basis and had to get their own password, and you're not going to have as much of that going forward. So that'll be something to watch in the future. But for right now, why does this make a difference to you if you're not trading Netflix? The answer is simple. This is a company that is heavily enough weighted in the NASDAQ 100 to move the entire NASDAQ 100. You've got a handful of companies like Bookings.com is a $3,500 a share company. There are 3 other NASDAQ 100 companies that trade for over $1,000 a share, but I don't know that they trade anywhere near the number of shares each day that Netflix does. And Netflix is a $535 a share company as of probably the open tomorrow, even more than that. And that has the ability to move the entire NASDAQ. If you've got, and here's the other thing about Netflix and why it should matter to you, even if you don't own shares of Netflix. If you have money in the Q index fund, if you have money in some other ETF that is NASDAQ heavy, if you have money in some of the big ETFs that are spread out through the 3 indexes, through the Dow, the S&P, and the NASDAQ, it's hard to uncouple the bigger, popular, more heavily traded stocks. It's harder to uncouple them than it's ever been before. A lot of people think, well, I don't own shares of Netflix. That's not going to affect me, but they have something in a Vanguard fund, or they have something in a Schwab fund, or they have something in a Goldman Sachs fund. Well, I guarantee you the people at Vanguard, the people at Schwab, the people at Goldman Sachs, the people at Morgan Stanley, they're going to have shares of Netflix in a lot of their different funds. And when those funds begin to do well, more people buy into those funds and it pushes more things up. And it has that ability to have that effect on your money, even if you don't think you own shares of Netflix right now. If you have any exchange traded mutual funds, if you have any of your money tied up in big mutual funds with big brokerage firms like JP Morgan, like Goldman Sachs, chances are you've got Netflix adding to your portfolio in some way or the other. And so it's going to have that impact. It's also going to potentially put pressure on companies like Disney. Disney is in a fight with Netflix for subscriptions and for users. Other companies that are out there, Paramount, Peacock, these other companies, all HBO Max, all these different streaming services, they're all kind of in competition with each other. You may not own shares of Netflix, but you may have a mutual fund that has some of these other things in it, or you might own Disney stock. And this can, at times, it can be a little bit tricky to figure it out. At times, a report like this on Netflix can cause your portfolio to go up, even when you have a bigger share, more holdings in something like Disney, because people will look and say, well, if this was good for Netflix, it's probably also good for Disney. But sometimes it can have the opposite effect. Sometimes it can have an effect where we think this is going to take shares of the market away from Disney. So far right now, Disney is up a little bit after hours, but as Netflix was moving up today in anticipation for this earnings report, Disney moved down a little bit today. And so it can have that reverse effect when it's a direct competitor. So be aware of that and pay attention to stuff like that. Now that Netflix has reported, you give it 1 or 2 days to trade. And the reason you give it, in FLX, let me get the right symbol in here. You give it 1 or 2 days to trade, and then when you're confident that it has broken through the most recent level of resistance, which it looks like it's going to blow through that tomorrow morning, when you're confident that it's done that and maybe come back down and tested that as a new level of support, then is the time to maybe do a directional bullish trade on Netflix. Don't try and jump in tomorrow, because you could see a massive swing up tomorrow at the open and then some sell-off before the end of the day where day traders are taking some profit out after that big pop. You could see Netflix jump up, come back down here, consolidate a little bit, test this previous resistance as new support, and then if they start to take off, that's when you start looking at getting into a bullish trade on Netflix. If this support level holds for a couple of days, that's where a lot of people can profit from a bull put spread with the strike prices down a little bit below that new support level, or a deep in the money bull call spread, down at the next level of support. Even if it's only paying 4 or 5% for a 3-week trade, that's a good return for a 3-week trade if you're averaging that out over a whole year. So we may end up doing a new trade on Netflix in the very near future, based on this earnings report and what it does in the next couple of days. I would not try and play this trade in the next day or two. I would wait until today is Tuesday. I would let it trade Wednesday. I would let it trade Thursday, maybe possibly get into something on Friday, or open something at the beginning of next week. We mentioned this in yesterday's podcast. I'll just bring it up again. I'm really reluctant to get into anything brand new that is non-directional prior to seeing those GDP numbers and that PCE number at the end of this week. And I talked enough about it yesterday that I'm not going to rehash the whole thing today, but just in a simple summary, those are both reports that can take even a good company like Netflix that might be trading really good tomorrow and Thursday. This could bring them crashing back down to reality if either of these numbers come in a way that causes the entire markets to sell off. For that same reason that I told you, it's hard to uncouple a company like Netflix from all the other companies that are in different baskets of mutual funds and ETFs. It's hard to uncouple any company from the market overall. If the overall index is trading down, oftentimes there's only a few companies that for a short period of time can overcome that momentum and buck the rest of the market. And that's true of Netflix as much as it is of anything else. So be careful. I wouldn't jump into something on Netflix tomorrow. But if Netflix trades up tomorrow and Thursday and maybe looks like they're going to open the day to the upside on Friday, maybe as early as Friday morning, I would get into a very directional bullish trade on Netflix, or something that could be stagnant, something that could profit from a stagnant to bullish trend. So we may end up talking about that at the end of this week. Thank you again for joining us for today's episode of the Moving Markets Podcast. I hope you found this information valuable or entertaining, or maybe some good combination of both. We'd love to have you come back and listen and watch each and every day that the U.S. stock market is open. Make sure you check us out at safeoptionstrategies.com or sostrades.com. Either one of those will take you to the same spot, and sostrades.com is a much easier URL to remember. But check us out at sostrades.com. Take a look at some of our membership options. Never forget the members of our program, they get the trades that we send out every week and real-time updates on those trades. And I love to brag about our results. Last year, we did 114% on the trades that we sent out to the members of the program. Those are real portfolio results, real returns. So make sure you check that out. If you're watching this on a YouTube, make sure you subscribe or comment. If you're watching it on some other venue, make sure you like us and make sure we're a part of what you're checking out each and every day. Thanks again for joining us. Bye-bye.